Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Markify. I'm your co-host, Joel Alconin, along with Brianna Valesky. We have Todd Sullivan on the line. He's the founder of Rand Strategic Partners. Todd, how you doing this morning?
I'm doing great. How are you?
Good, good. Thanks for coming on the show, and I know you've been on a few times in the past, and you've had a pretty bullish stance. Is anything that's happened in the last couple of days shaking you from that?
No, not at all. Actually, if I would say anything, I'd say I'm becoming increasingly optimistic about the economy. And then by nature, since the market follows the economy, I'm thinking that the market's going to continue to go higher.
So if you're bullish about the economy and the growth picking up, are you worried about what Auntie Jeanette is going to do with interest rates?
No. I have been of the opinion for quite some time that higher interest rates in the U.S. would be a good thing. That if the Fed were to steadily and incrementally raise interest rates, you'd see a large increase in bank lending to a lot of people who are shut out of credit markets right now. And really, if you look at the economy, housing's the last thing to recover, right? I mean, everything else is pretty much back to where it was. Retail sales is higher. The employment levels are fantastic. Everything's doing well except housing. Housing is still well below, as far as volume of sales, well below where it was in, a decade ago even. So the reason for that is simply credit availability. It's just not there. So higher interest rates, I think, would open credit to a lot of people who are currently shut out of the housing market, and you'd see housing go from the 600 to 700,000 annual level back to 1 million, where it should be. And if that happens, then GDP is going to go up substantially. The market will follow, and I think you'd see several years of strong economic results. So I'm not worried about interest rates raising at all. If they raise them, it's going to be because the economy is getting better, and that's a good thing. Now, the market in the short term might, panic or jump around, but over time, it'd be a good thing.
Help me out here. You're thinking higher interest rates would be good for the housing sector? Because you think that people would have to pay more for their loans. Help me out here.
You know what? If you go back and look at traditional data, higher interest rates haven't correlated with crashing or decreasing home prices, okay? There may be, again, quick reactions or gut check reactions where for, a couple months people wait for interest to fall, but they don't. But the reality is higher interest rates expand credit. Expansion of credit allows more people to buy homes. That means more increased housing activity. It's the way it's been historically and the way again. Now, if you're talking interest rates going from 7 to 12%, again, that's a shock to the system. That's not something you want. But, interest rates going from, what's a home now, 5% to 5.25% to 5.5% to 6%, those aren't interest rate increases that are going to damage your housing market that, let's be honest, the only real problem with it is a lack of supply. We don't have enough homes to sell people, which is why house prices keep going up. So you want to get builders off. You want to get builders building homes. You want to get banks lending to more people. It's going to take some higher interest rates for that. Because right now banks are not extending credit to even marginal borrowers. They're not being compensated for that risk because rates are so artificially low. You get a little bit of higher rates, you get expanding credit, you'll help the housing market.
Yeah,
and I've had this for quite some time. So
yeah, I have to agree with you on that. I've been kind of looking in the housing market for a long time, and I'm like, sign me up for a 30-year loan at these rates, and I'm not really worried about them getting away from me either. Are there any particular stocks in the housing sector that you're keeping an eye on?
So the builders look good. Lennar is one that I really like. I think they own a lot of their land. They were big buyers of land in the recession, so they're not competing with a lot of other buyers right now who are buying land that's been inflating rapidly. My favorite, Howard Hughes, is another one. They own all their land. They're building homes on land they already know. they already own, so their acquisition costs to increase their business is minimal. So those are my two favorites.
So Lennar, that they were out there, buying up the land when everyone was going under and selling. So,
Yeah.
yeah, we'll keep an eye on that as well. What else? I mean, market up near all-time highs here. I mean, if you're out there looking for value, where's Todd Sullivan looking at in the market?
The financials are still cheap. All the financials are still cheap based on historical levels. And again, the reason they're still cheap, I think, is because you have a over-aggressive regulatory regime, which I think is going to change after the next election. And like I said before, rates are low, so lending's not really there. The financials are still cheap. I think the home builders have years ahead of them to run. Those are two big areas that I'm still bullish on. And I still love companies like AIG. It's trading below book value and has some catalysts ahead of it where they're going to buy back $5 to $10 billion worth of stock, which is going to, once it's announced, it'll be a huge jump in the stock.
I mean, who talks about AIG anymore? I mean, it's like
Nobody.
Yeah, I mean nobody. So we'll keep an eye on this one. It's definitely had a nice run up here since February. A little bit of consolidation here. Looking at the weeklies, haven't talked to you about oil yet here. Kind of breaking down again here. Was having some support here. Anything to do in the oil patch?
I don't think I could see a scenario where we're having the same conversation about oil next year at this time. Any price increases is going to lead to increased production, right? All the rig count dropped, 52%, I think it has in the last year. So we're at a point now where production has been somewhat rationalized based on price. So you get any kind of bump in the price of oil, and you're going to have these rigs come back online. So, maybe this is the level, this $50 to $70 level where oil sits for quite some time. And that's a good level for the economy, keeps gas prices moderate, more money in consumers' pockets. And over the longer term, that's going to be a beneficial thing. Now, it's not great for a lot of your majors and your oil drillers and a lot of your pure play fracking companies. But once you have the price stabilizes, then people can, match their operations to the price of oil. It's when you have these big drops and spikes that you kind of get crazy reactions. So, but I can see production being cut some more if the price drops. I don't think that the U.S. guys are going to let the price go below 50 and let it stay there. I think it's going to be in this $50 to $70 range, and they'll adjust production accordingly. So, this all doesn't assume there's some war breaks out in the Middle East, which causes prices to go crazy. So, assuming that doesn't happen, I think that's where we are for oil.
Any place for gold in your portfolio?
I've never invested in gold. To me, it's a shiny rock. And, I know some people think about it. They're really high on it as an inflation hedge and that kind of thing. But the reality is if we ever needed gold as money, there's not enough of it to go around. So I think it's more of a mental trade than anything else.
Yeah, I mean, it's been stuck north and south of this $1,200 level for quite some time and just hanging out above the lows. Is a lot of sector rotation going on here, and what do you think? What do you think that the next sector where they're gonna roll out of and put their money into?
You could see, assuming we start getting some interest rate hikes, you could see some people start rolling out of some of the dividend stocks that they've been going into the last couple of years. I think tech probably remains hot simply because the innovation, we're in one of those periods where the innovation coming out of the tech sector is just amazing. I mean, every day you pick up the paper, there's something new you can do with your phone or a camera or an app, and it's just amazing what keeps coming out. And more of these companies are going to keep coming public. So I think you're going to keep seeing really strong interest in the tech sector. and what's going on there. And I think, your utilities, some of the higher consumer discretionary dividend stocks, as rates start going up a little bit, I think you might see a rotation out of them. But as of now, that's what I see.
What about social media stocks here? Been out of favor. I mean, except for Facebook, your Twitter
Yeah.
has been out of favor. Those stocks don't sound like they're on your radar. You sound like a pretty strict fundamental guy. And any take on any of these social media stocks?
Well, I mean, Twitter hasn't really found a way to monetize their product, right? And they've done some things over the past year and a half that have pissed people off. And honestly, I'm not. How sticky is Twitter? Facebook, I think, is very sticky. Facebook has found a way to monetize their product a lot better. I mean, if you go through your Facebook feed, the ads are appealing. I find myself clicking on them just because they have some intriguing stuff there. So Facebook has done a much better job, and people moving photos and things like that to Facebook. I think it has a lot more stickiness to it, especially with your older generation who's not likely to swap to the next hot app. Where some of this stuff, I'm just not sure. I'm not sure who the next MySpace is, right? Where the next thing comes along and people start switching. There's a lot of it out there. You have Twitter, you have Snapchat, you have Instagram. There's all these things out there that allow people to share, and people do tend to hop around in that stuff. So until Twitter finds a way to successfully monetize their product, I'm not sure I'd want to be an investor in it.
Okay. All
Facebook,
right.
on the other hand, Facebook has, they have something going. So
They definitely have proven themselves. Any sector you think that's been just kind of behind? You mentioned the housing sector. Anything that's been beat up as of late that investors should take a look at.
the energy. It's funny. The energy sector hasn't beat up, but not to the point where. I mean, you look at Exxon. Exxon is down from 95 to 84, and the price of oil went from 100 to 50. There's a lot of these major oil companies that I don't think have really reflected the damage done in the oil sector. Now, some of the smaller companies have, but I think you're taking on a lot of risk with them because of the fact that we don't know if oil is going to bounce back to 100 or it's going to just stay at 60 for the next year and a half. So the oil patch is one where if there was a little more damage in, I think it would get very, very, very interesting, very quick. But some of the majors just it's acting like this is a bump in the road versus a potential readjusting of oil prices for some time.
Have you taken any chips off the table? Anything hit your targets or valuations where you just think, hey, maybe it's time to redeploy the assets somewhere else?
I like what I own, and I'm still operating on the general thesis that the market in a year or two is significantly higher than it is now. And I don't own anything that I think, this is overvalued, or the prospects for the next year or two and what I own aren't going to be better than they are now. So for me, that means there's no reason to sell it. I don't know what's going to do over the next 3 months or 6 months, but as I look across the things that I own, AIG, Howard Hughes, Bank of America, things like that, as I look a year or two down the road, I see much better things coming. So I'm content to sit here and hold it. If we do get this 10% correction or 5% correction in the market people have been calling for the last 5 years, then I'd be happy to add to any one of those positions if they were to suffer because of that.
What's the symbol on Howard Hughes?
HHC.
Oh, okay. I know you've been talking about that. That's kind of a thinner stock, isn't it? Doesn't trade a lot of volume, but
it doesn't trade a lot. It's closely held with people, and it's an asset play. They have premier real estate assets that they're developing, and I think it's 140 something, 147 now. I think it's worth 250 easily in the next couple of years. So
Keeping an eye on that one. What would you say to someone that wants to get into the market and they're just kind of they want to keep up with the market, the S&Ps, the dividends and stuff? I mean, there's really, I mean, your stocks like your AT&Ts and your Verizon. I know Verizon, made that purchase. I mean, if you're looking for yield. Okay. I mean, do you think that there's any risk in getting some assets like this and just sitting on it, hoping for some capital appreciation, dividend reinvestment? Do you think that's a sound strategy, or do you think people should aim for a little bit higher rates of return?
oh, I mean, I think it all depends what your lot in life, right? I mean, are you 50 going to the market for this time, or are you 25? If you're 50, then buying some of these dividend stocks, getting your 3 or 4%, I think is a really smart way to go, because the yield is going to help support the stock, unless the Fed raises rates to 4 or 5%, and then that's a whole different ballgame then. So you're going to get your dividend checks. If you're in your 20s and 30s, and I'm not necessarily sure that those are what you want. Now, should they be part of your portfolio? Sure, but I think you can take a little more risk, and you can look at your Facebooks. You can look at the things that as a 22-year-old that you use, your GoPro, your Facebook, your Apple. You look at stuff like that, and you ride those for a much longer time, understanding there's going to be some volatility. But your Verizons, your AT&Ts, I mean, they're going to be around. CVS, and CVS is becoming a monster. And they're going to be around for quite some time, and they're going to be producing cash flow for quite some time. Barring some bizarre government regulation against AT&T or Verizon, they're going to keep kicking out dividends for years to come. So if you're getting to that point in your life, then that's the way to go. I'm not a huge dividend reinvestment fan, simply because if the stock's going up, I'm not sure that money in the dividend is making the best purchase. Maybe you should take that check into your account and then see what's cheaper and use that money to buy additional shares of something that's cheaper in your portfolio versus just reinvesting in a stock that may be going up and up, and you're not getting the value for that dollar you're spending.
Did you get caught in this Coors debacle at all? I mean, showing a little green today. Did you manage to stay away from that one? And if you did, I mean, maybe I know you're always looking long term. Maybe something for this, maybe right for a short term pop.
There was a fascinating tweet on it yesterday, and for the life of me, I can't remember who said it, but the thesis they had was that Michael Kors might be getting hit because of the Apple Watch. Michael Kors is they're a big watch seller, and if people are in droves going to this Apple Watch, some of these big watch sellers might get hit significantly. And you know what? Fashion it's fickle. I wasn't in Michael Kors. I prefer something like a Costco over a Michael Kors. Not as flashy, but to me it's far easier to predict that people are going to really want whatever Costco's selling next year versus fashion trends with Michael Kors with high-end handbags and watches. So, but I thought that was an interesting thing that Michael Kors and the watches and people going to Apple. I could see it, right? It makes sense to me. So I don't know that I would be getting into Michael Kors right now. I think I might want to sit and watch for a while and see what sort of comes out when they report the next quarter, see if this was a one-quarter aberration or a trend where people are defecting off some of their high-margin watches. It's a high-margin product. So
yeah,
if people are leaving, if people are walking away from that to buy Apple Watches or even Samsung or any of these smartwatches, then that could be a problem for them.
Yeah.
People go to the stores. You go into the store to buy a watch and you pick up whatever else. If you're not going there for that watch, that's a sign of a bigger problem.
Yeah, the institution said goodbye to that yesterday. Traded monster volume, showing a little green today. Opened up on its low for the session, 45.61, climbing back into the 46 handle. Well, we've had Todd Sullivan on the line. He's the founder of Rand Strategic Partners, a long-term investor, long-short hedge fund, and the author of ValuePlays blog, angel investor as well. Todd, you're a busy guy. Thanks for coming on. We hope to speak to you again soon.
Thank you.